Well, good morning, folks, and welcome to the first analysis for 2011. And what an interesting market it's proving to be as we start the year. I hope you've all had a good holiday and a good rest, and I'm pretty sure that 2011 is going to be a pretty good year for trading. And as always, I'm optimistic that we'll do well and make lots of money. So, as I said, I hope you've had a good rest, and let's kick off the year with a good start to January and moving on into the rest of the year. This part of January is normally a pretty good time to trade now that the markets are more active again and people are back from holiday. So from this week onwards for the next month or two, it's normally a pretty good time in the market to be trading, and we should see some good trends and some good opportunities to make money. Let's have a look at the euro, and I've got the euro hourly chart on the screen, and you can see I've got a red line drawn at the top there, and that's the weekly reversal level. And what I want to do is just to show you how I arrived at that, and I'm going to go across to the weekly chart here. And as always, I'm using the same screen as I do for the hourly chart. You can ignore all the indicators. The only thing I'm interested in here is last week's candle and looking at the direction of the candle and the reversal level. So you can see last week's candle was definitely bearish. In fact, it's a bearish engulfing candle, and the previous week to that was somewhat bullish, but last week was a nice strong bearish candle, and it's engulfed, in fact, all of the previous 4 or 5 weeks. I've drawn the line, this red line at the top of last week's candle. Because last week was bearish, we'll continue to trade in the bearish or short direction this week. And the weekly reversal level, this red line here, is the level at which, if the price reaches it and closes above it, that means we've abandoned the short direction and we stay out of this currency for the week. We're well below that level at around 1.34 right now. We're at 1.29. So about 500 pips above us is where the weekly reversal lies. And as long as we're beneath that level, we'll continue to trade the euro short during this week. You can see as well that this red line, interestingly, also happens to be around about the 100-period moving average, the 100-week moving average. But that aside, you can see it's also the high of the previous 1, 2, 3, 4, 5 weeks. Apart from that little spike over there, but it's a definite resistance level, and it's a very important level over the last 5 weeks, and it's also the weekly reversal level. So in summary, whilst we're below 1.34, we'll look to continue to trade the euro short. And what we can do now is go back to the hourly chart like that, and I'll just get rid of the favorites bar on the top there, and there you can see I've got the weekly reversal level drawn in. That's the red line which I put in on the weekly chart. And if I sort of zoom out of the charts and compress the chart, you can see on the hourly chart, you can see where that resistance level is as well. So it's tested this level on multiple occasions. It's been a support area, resistance, resistance, resistance there, and more recently we had a double top on the hourly chart, actually just before the new year, and we've moved down since then. So the strategy is to trade the euro short this week on retracements, and as long as we're beneath that 1.34-ish level, the weekly reversal level. So if I go back and have a look at this in a closer view, I want to now draw in some black lines. These are the support and resistance lines which may create opportunities to sell. And as always, I just put a black line in wherever I see a key level. There's one there. Obviously, that's a support area with support back here as well, over there with this little inverse head and shoulders, in fact. And I could also draw one over here. There's a previous resistance level there, and I'm going to put one more in. I'm going to put that in over here, which was previous resistance and support. So I've got 3 black lines. I'm not going to go into too much detail at this stage. I just want to see what the overall picture looks like. So I've got my support and resistance lines in there. Those act as important barriers and areas where the trade might kick off from. And then I'm just going to draw a simple Fibonacci from this big swing high to the swing low, and I'll just draw my fib retracement in like that from the top to the bottom, just like that. And there you can see the retracement levels. Some of them coincide quite nicely with the black lines I've already drawn in the chart. And in fact, what I'm going to do is also put the 25% retracement level in, simply because this is such a large movement downwards, and so we might only retrace to 25%, for example. So I've got all of those in there: 78.6, 618, 50, 38.2, and 0.25. And those are all levels where if the price retraces up to those levels, they would form potential areas or zones from which we might like to trade from if there is a G7 signal. We've still got a long way to move up. We're at 1.29 now. The next key resistance level is at the big round number 1.3. That's where the 25% Fibonacci is. And so we've got to move up at least 100 pips before we get an opportunity to sell. And so we'll be looking for the euro to move up into these levels, hit one of the levels, form a G7 entry signal with all the other conditions that need to be in place before looking to sell the euro for a move lower. Well, that's the euro, and I'm just going to reset that, and I'll save this. Alright, so I've saved that one, and what I'm actually going to do is just to shrink that down and pull the pound across into the window, and we'll do the same sort of analysis for the pound. So what I'm going to do, as I did with the euro, is just to get the weekly chart up. And this is interesting because the pound is in fact in the opposite direction to the euro this week. So there's the weekly chart, and if I just zoom right in and have a look at last week's candle, you can see it was a bullish candle. It was an inside week, in fact, so we've got a lower high but a higher low, but the previous week was a bullish candle. So there's the bullish candle. Last week was an inside week, and which means that we're contained inside the range of the previous week. So compared to the previous week, lower high but a higher low, that's called an inside week. And an inside week is a continuation pattern, and it means we continue to trade the pound in the long direction. And the reason I've drawn this red line down here instead of below last week's low, I could have moved it there of course, is because the actual bullish week, the actual bullish reversal week, was the one previous to last week's candle, but it's also a key level. And if we zoom along, let's just reset this, it's also a key level all along here, this red line. So it's a natural support area created by resistance there and resistance here and support here. So I've just moved the red line down a fraction, just a little bit below last week's low, to accommodate this very key level. So it's just, I don't know, like probably 50 pips lower down, and as long as we're above that red line, we'll continue to look to trade the pound in the long direction. In other words, we'd be looking to buy the pound this week, whereas we're looking to sell the euro. So two different currencies in two different directions against the US dollar. So I'm going to go back to the hourly chart and reset this, and we'll have a look at what's going on. Just get rid of that. And so you can see there's the hourly chart. And if I scroll down a bit, there's the red line, which I put in on the weekly chart. That's the weekly reversal level at around 1.5350. And if we move down to levels beneath where we are now, as long as we're above 1.5350, we'll be looking to buy the pound this week. So that's pretty clear. And what I want to do is now have a look at the potential support areas. Remember, before we buy the pound, we need a G7 entry signal. And so we need to see the stochastic oversold. We need to see the price at or around about these moving averages or Bollinger Bands. And we need to see support or resistance levels formed by black lines and the Fibonacci levels. So we're pretty overbought on the stochastic right now. So there's no opportunity to be buying the pound just yet. And we need the price just to move down a little bit. Perhaps down to some of these levels here where the moving averages are, and perhaps even a little bit lower down to some other support lines. I need to put the support lines in, so what I normally do is, as you know, I just zoom out from the chart just a little bit, and I start to look for areas where there are key levels. Now I'm just looking across to this area here. You can see there's a resistance level there. There are actually quite a few, and it's quite a messy old chart actually. They're not actually all that clearly defined, but I'm just going to try and put some in. When you've got a messy chart like this, sometimes you've got to kind of just estimate, put these lines in the best possible position, even though you might be chopping off bits and pieces of candles here and there. Don't worry about that too much. We're not looking for precision in terms of support levels. Sometimes when the chart's messy, it's not all that precise. You can see this one I've drawn in here is kind of in that zone. It's a kind of resistance area over here, support around here, and support there. So I'm just going to leave it right there for the moment. As I said, it's not precise, but it'll work and do its job for now. The next thing I'm going to do is to put a Fibonacci in here. I'm just having a look. Now remember, we're looking to buy. See what a mess it looks like when you zoom out like this. So I'm looking to buy on moves lower, so I need to draw a Fibonacci from the top of a swing down to the bottom. There's the very high, and there's the kind of low where we are right now, but there have been all sorts of moves in between. So really, to put a Fibonacci into this mess really doesn't make a lot of sense, because there's no clear swing high and low. For example, if I go back to give you a better example, you can see the pound's actually been messy for quite some time. But if, for example, we were drawing a Fibonacci in this area here at the start of this week, it's pretty easy. There's the swing high down to the swing low over here. So there's a swing high. We moved all the way down to the swing low, and there are the resistance levels formed by the fib. In the case of this week, let's go back to where we are right now. You can see there's no clear swing. We've just got this sort of zigzag motion all over the show. You can see the market's been really thin. Not a lot of volume in this market in the first week of the year, and that's what's created these big moves, really random moves, but of large magnitude. And often what that means is that the markets are quiet and thin, and there's not a lot of direction in the market, but there is some activity created by perhaps some large funds moving around in a market where there isn't a lot of volume. And of course there would have been some news coming out during these spikes as well. So not much to add in terms of fibs. Remember, we want to be buying on dips, and so there's no point in drawing lines above where we are right now. What I'm going to try and do is just a little bit of a fib over here. So really we've only got one option. We've got a swing low there and a swing high, and so I can just draw a little short-term fib. Not that it's going to be of great use, but I'll just put it in like that. And let's have a look at what we've got. You can see the 38 and the 50% Fibonacci's coincide roughly with where these moving averages are. So there's the 618, the 78.6 fib all the way down here, but it also coincides with this black line. This is a very short-term Fibonacci, and anything to do with trading, when you go shorter and shorter term, the analysis becomes less and less robust and less significant. For example, trading off tick or 1 minute charts, when you look at candle patterns on those charts compared to, let's say, candle patterns on a 1 hour chart, the tick charts and the 1 minute charts, candle analysis is less robust, less important, and holds way less weight than if you go into the longer term, bigger scale things. And the same goes with Fibonacci's. So we've drawn a very short term fib here, and it's just really there for interest's sake, but it's not going to hold as much weight as a much bigger swing analysis with a Fibonacci. So in summary, we're looking to sell the euro into rallies, and as I showed you on the previous chart, let me see if I can get it up here, we need the euro to really rally. Let's just have a look. So there's the euro. We need it to really rally up to these levels before we even have a chance to sell. And the first port of call, the first opportunity, if we get a G7 signal, would be at around 1.3 and further up, as long as we're beneath this red line, which is a weekly reversal level at about 1.34. So that's the euro, looking to sell as long as we're beneath 1.34 if and when we get a G7 signal at some of these levels. And you can just pencil some of these levels in on your chart by pausing this video and drawing these lines in for yourself. But we will go through it again tomorrow in tomorrow's webinar. The pound, opposite direction. We're looking to buy the pound as long as we're above this red line at 1.5350. That's the weekly reversal level, and we've got a few short-term fib levels beneath us. A very messy chart, and we'll have to really keep an eye on this closely to make sure we don't get caught up in some of this sideways, choppy, and fairly random movement. I think the market volume will begin to increase from this week onwards. It's normally the best time to start trading in January. The first week in January after Christmas, normally a poor week to trade, and as is the first say 10 days before Christmas is a poor time to trade. So the 3 weeks between around about the 20th or the 17th, 18th of December, and then the first week in January, including that week. Those 3 weeks are normally the worst time to trade in the markets. It's always a good chance to be out and to take some holiday. I'll see you all in the webinar tomorrow. I've got some interesting things to discuss, and I want to go through what lies ahead for this year. There are going to be some changes in terms of what we're achieving or what we're trying to achieve and the way we go about it. So some pretty exciting developments, and I'll let you know all about that in tomorrow's webinar. And I also want to briefly talk about the TFD program in more detail in the webinar tomorrow. I'm not going to cover it now because I want this video report to be in your hands as soon as possible. I'll see you tomorrow.